And now, please join us in a very warm welcome to our first guest, Dr. Janet Yellen.
So thank you so much, Dr. Yellen, for attending our forum. As an icebreaker, here is my first question. What has been the most challenging or exciting moment in your career?
Well, first, let me thank you for the invitation to join you. I think, without doubt, the most challenging times that I've experienced in my career are ones where we've had to deal with financial instability. And, of course, the financial crisis of 2008 stands out in that regard. The Federal Reserve was really created after the bank panic of 1907 to serve as a liquidity provider of last resort through its discount window. Unfortunately, this was dealing with bank runs was something that the Fed had to do infrequently. Suddenly, in 2008, we're seeing not only runs on banks, but what look like runs on a huge range of non-bank financial institutions, including all of the major investment banks. And the challenge was, once we realized, and it took a long time to realize what was causing this huge financial disruption, that enormous amounts of leverage had built up in the financial system outside of banks. I was president of the Federal Reserve Bank of San Francisco then, and I was following developments in housing closely. Many of us thought subprime lending, while very worrisome, couldn't really cause a financial crisis. That was clearly a wrong judgment. And I only began to see in 2007 is I listened to anecdotes from directors of our banks, the extent to which lending standards had deteriorated and leverage was building up through the financial system. But it was really only in 2008 that we began to understand that we had a gigantic shadow banking system that was essentially not well regulated and had enormous runs. And the challenge was how to avoid the runs on these institutions turning into a second Great Depression in the United States and throughout the world. And of course, we knew the discount window had to be central to that, but how to use the discount window to get the necessary liquidity to non-banks was a huge challenge. It made us feel as though, this is, we're firefighters, we've been hit with a 10-alarm fire, and for us inside the Fed, this was 24/7, figuring out how to stop a collapse of the financial system that would have curtailed credit to the entire economy. And it was a serious intellectual challenge as well as an emergency. Later, when interest rates were lowered to zero, I don't think there was anyone who could have imagined that they would stay at zero for 7 full years. And we had to struggle to figure out how to help the labor market recover all the jobs that had been lost. That was also intellectually and practically a huge challenge.
Well, thank you very much for that. So, following up on financial stability, over the past few years, the global economy has been tested again by successive shocks. So from your perspective, what is the biggest macro financial risk markets are underestimating today?
Well, I reflect back on the fact that up until the pandemic, even the beginning of the pandemic, interest rates were exceptionally low. We were still in this essentially zero rate regime. And I think the view had taken hold that interest rates would remain low for the foreseeable future. And a lot of debt was accumulated and exposures taken on during a time in which it was expected that interest rates would remain low as far as the eye could see. When I looked at the United States, for example, and we had at the time a federal debt to GDP ratio of around 90%, 95%. Well, that's very high by historical standards. But when people ask me, should we be worried about this? Well, look, I thought, okay, the base case is one in which interest rates stay low. We should look at the interest burden on the federal debt relative to the size of the economy. And while 90 or 95% is a high debt to GDP ratio, the interest burden's very low. And that's not so worrisome. And debt levels, sovereign debt, but private debt in some sectors as well, reached high levels during this low interest rate time. Well, now we're in a completely different rate environment, and there's a lot of duration risk and refinance risk sitting out on balance sheets. When I was Treasury Secretary in 2023, we saw what its implications were for Silicon Valley Bank and had to struggle to make sure we didn't have a banking crisis as banks had taken on long maturity debt that wouldn't have been sensible if you knew that interest rates were going to rise. I'm particularly worried about stability, financial stability risks from sovereign debt. The United States is running very large deficits, the largest in outside of wartime and outside of a recession, around 6% of GDP, and we're on an unsustainable course with respect to fiscal policy. And now interest rates are higher, and the debt burden is no longer at the low level that prevailed when I thought there's nothing to worry about, and now I think there's a lot to worry about. At the same time, so we've been issuing and will continue to issue a lot of debt. There's no serious discussion of deficit reduction, which cannot be done in a painless way. It has to involve higher taxes or lower spending on programs that support retirement, Social Security, Medicare, and well, longer-term interest rates have gone up. They have not obviously gone up in line with the fundamental problem that sovereign debt now poses. There's no immediate crisis in evidence, but I can imagine events that could trigger a market rethink about what the appropriate level of compensation is for fiscal risk. And we'll probably talk more about fiscal dominance, threats to the central bank, but certainly we're in an environment where the interest burden now exceeds in the United States defense spending. I could imagine an abrupt rethinking by market participants about what the appropriate level of longer-term interest rates are. And that could affect valuations, leveraged investors in many sectors of the economy that could trigger financial instability. I think the other thing I would note is that in past financial crises, international cooperation, especially among central banks, has been critical to effectively addressing financial instability. And given the fragmentation and tensions in the global economy that you referred to, I do worry that cooperation would not be, central bank swap lines and the like, would not be as automatic as they were in the past.
So I'm gonna follow up on fiscal policy, because I think it's really important right now. The monetary policy frameworks have to adapt rapidly, while public debts, as you were mentioning, continue to rise everywhere. So do you see a risk of fiscal dominance over monetary policy? And at times of crisis, is the monetary and fiscal policy coordination desirable or not?
So with respect to fiscal dominance, even in the United States, where I see the greatest threat, let me start by saying that is not the regime that we're in. You have seen the Fed raise interest rates, even though it is creating greater fiscal pressure, higher interest rates, at a time when debt service is getting to be a very worrisome and burdensome issue, and the White House and Congress are obviously very concerned about it. I see no evidence that monetary policy decisions in the United States have been anything other than what a group of very thoughtful and analytic people on the Federal Open Market Committee deemed to be appropriate in light of the risks in their forecasts. But is fiscal dominance a concern? Absolutely. I have never seen before threats to central bank independence that come close to those that we've seen over the last year or so. You have a president who is attempting to remove a Federal Reserve Bank governor for cause, and who has threatened criminal charges against the chair of the Federal Reserve. In addition to that, he's argued explicitly for very large reductions in interest rates that I can hardly imagine that anyone in this audience or in central bank world would regard as appropriate under the conditions that we have faced. And the explicit reason he's given for it is because the interest burden on the federal debt is really problematic, and he thinks the United States is a great creditor and we should be rewarded by low interest rates. But the Federal Reserve, you don't hear the president talking about the importance of price stability. And what is fiscal dominance? It's a situation in which the central bank loses the independence to make monetary policy in line with its mandate, and every independent central bank, which is most around the world now, has price stability as a key part of its mandate. The United States also maximum employment. But, I mean, central banks were made independent in order to be able to focus on price stability and to be able to resist pressures from elected political leaders to charge interest rates that help manage fiscal debt. So, you know, the idea that would become the driver, and worrying about the interest burden on the debt, pressures to print money, that if you look around the world, really, I think it's hard to find any prolonged episode of high inflation or hyperinflation that is not driven by fiscal dominance, lack of central bank independence. So I think the threats in the United States are certainly very real from fiscal dominance. I don't see it yet. When you ask about coordination, no, I mean, most of the time, I don't see a role for coordination. The Fed, during all the years that I've been affiliated with it, the attitude is that's decided on by the administration and Congress. We take that as a given. We craft a monetary policy that's the best we can to achieve our price stability and maximum employment mandate given to us by Congress, taking the path of fiscal policy as something we have to accept and adapt to. Now, it is a long tradition in the United States that the Secretary of the Treasury and Federal Reserve Chair meet once a week for a breakfast or lunch to discuss the economy. So I'm not saying central bank and White House or elected officials, they certainly should be talking about the economy, understanding their separate responsibilities and plans. That's very important communication, but the central bank must be allowed to decide fiscal policy that's appropriate to achieve their mandates. I mean, the time that cooperation is needed is in financial crises. The central bank's role in being able to use its balance sheet to make loans to financial institutions that are suffering from liquidity pressures. As I said, that's why the Fed was created. But at least in the United States, and this is, I think, true in some other countries as well, the Fed is not allowed to make lending except against collateral that protects itself against loss. And when there is the possibility of loss, there's a two-key system that applies, which the administration, the political authorities with fiscal resources at risk, they have to be willing to insure the central bank against loss to take on that fiscal risk. And the central bank has to be willing to use its balance sheet to make loans, and cooperation's essential there.
So now the inflation growth balance. Of course, the conflict with Iran introduces new uncertainty into energy markets and supply chains. So in your view, how is the outlook for inflation and growth evolving? And is the US story so different from other regions?
Well, the US story, and I think in some other regions as well, the oil shock, well, it's a little bit broader than the oil shock. It affects food, it affects helium, semiconductors, natural gas, of course, is dominant for many countries. The United States actually is suffering from three distinct supply shocks. First, we had the impact of tariffs. So we went through a period of very high inflation after the pandemic. Inflation was coming down. It got down to 3%. Without any of these three supply shocks, I believe it was widely expected to fall this year back to 2%. That resulted in kind of a bias that with inflation back to the Fed's target and the labor market holding up and monetary policy slightly restrictive, there was an expectation it would be appropriate to cut a little bit more. Then we had the tariffs. Well, that's a one-time price level effect. It takes a while to play out. Right about now, most economists thought that will wash out and we'll see core inflation getting back to 2%. Well, yesterday we had a CPI release. Inflation over the last year has been 4.2 in the CPI measure, and even core inflation is very close to 3%. So we're not back yet, but there was reason to hope we would be. Then along comes this huge energy shock, and of course we don't know how long the disruption is going to last. So there's tremendous uncertainty. But now we have another supply shock that will continue to keep inflation, at least for the remainder of this year and into next, above the Fed's target. And then at least in the United States, and I guess in some other countries, perhaps in the EU as well, we have massive investment in artificial intelligence, which is in the US pushing up electricity prices and is generally pushing up semiconductor prices that are incorporated in a huge range of consumer products. And that's probably going to go on for a while. I think you could argue that each one of the things I mentioned, well, they're supply shocks. They should have one-time impact on the price level. Central banks, at least the Fed, typically look through such shocks. But think about it. It's now been 5 years since inflation has been above the Fed's target. Now we're looking at the remainder of this year, likely next year. Inflation is going to remain above the Fed's target. Maybe the AI boom is going to extend that into 2028. And what's really critical for the Fed and many central banks is inflation expectations. And whereas inflation expectations in the United States have been very well anchored, with one supply shock after the next and we not getting back to 2% inflation, there's a real risk that inflation expectations move up. And that could cause inflation to become ingrained. Meanwhile, the labor market, which at least in the United States looked fragile and looked like it was weakening, all the recent data in recent months suggests quite the opposite. If anything, the labor market is strengthening. So I would say in the United States, well, I wouldn't expect an interest rate increase in the next several months. I think that would be very unlikely, especially with uncertainty about oil. Certainly, any case for a cut in rates has really disappeared, and the market is now pricing that in. You can see that. And is a rate increase possible? Yes. I guess maybe some of the people in the audience know what the ECB decision was. I guess it was announced while we've been talking. The guess was that there would be a 25 basis point increase. I mean, in the euro area, you see meaningful upward pressure on inflation. Again, should be something that's transitory, but worrying about second round effects. So I think there is some difference. The growth is somewhat stronger in the United States, or the outlook is for somewhat stronger growth than in the EU, in the UK. And Japan is its own special case. But the inflation pressures are real, and I think the outlook for interest rates has changed.
One last question, because time flies. I wanted to speak about labor market a bit more. Of course, across major economies, labor shortage and demographic pressure are increasing, while AI should significantly boost productivity. So which force do you believe will prevail?
Well, my instinct is that productivity will prevail in many countries. I think in the United States, probably the same is true. I think AI, those who understand it best are very optimistic about the productivity gains. A proviso is it requires a lot of investment, not just in building data centers, but also by firms that need to make organizational changes and investment to make best use of it. And so it often takes longer to see the benefits in improved productivity can sometimes take decades. Maybe AI will be faster, but there could be a lag. I think it will be important, but demographics are baked in the cake. We're seeing aging populations in most developed countries, in China and in Korea and Euro area, the EU, UK, US. In the United States case, our treatment of immigration has led to a larger decline in labor force growth. So that concerns me. But both forces will be in effect, but I'm optimistic, although the transition will be difficult on the gains for the future from AI.
We will end on the optimism.
That sounds great.
Exactly. Thank you so much, Dr. Yellen. Thank you for being here with us.